It is remarkable to see what happened over the past 24 hours. Stocks rally 1%, bond yields come in about 10 basis points. Jay, are you also in the camp of the dip buyers this time around?
You know, we are, although we're a little bit conflicted. So if you do, it's really just arithmetic. We use the terminal to do it. But if you look at PCE core, we're coming up with 0.5, which is horrible. And that's going to be at the end of the month. Now, we do have PPI as well. But it's fairly deterministic. It's just taking CPI and doing different weightings.
Sure.
So that's really terrible, so you could easily be bearish. But you really already covered the bull case earlier today, talked about the UK. We've been saying for 6 months that the Eurozone was going to go into a major recession. It's actually been now it's flat and going into a minor contraction because you do have very strong exports to the US. So the domestic economy, very, very weak in Europe. And so you'd mentioned the rally yesterday. Well, a lot of US investors don't look at Europe. You just wake up and look at NVIDIA. But there was a major...
You're not wrong.
Yeah, that is the US market.
There was you can, with equities, you can safely ignore the rest of the world, which is unfortunate and arrogant, but true. But you can't ignore the worldwide bond market. So yesterday, as you noted earlier, we had very low, very negative inflation in the UK, negative 0.6 versus expectations of negative 0.3. And when we look at what we call the roll down for the Eurozone, it's going to be dramatic. So that's why we're calling for a June rate cut. We think that's nearly 100%. I noticed headlines going by in the terminal. Now, all the European officials are agreeing with what we said 6 months ago, that there is a problem.
So if it's that nihilistic in Europe, I mean, that's a fairly brutal call, and that would not be probably consensus. So it's very interesting to come in on Bloomberg Brief at 5 a.m. in New York and listen to somebody that actually knows and talks about what's happening in Europe and the UK. So if the first rate cut is in June, the market has gone from 7 to 3. Given the slowdown in the UK and in Europe, you're saying that that actually can have a material impact on policy here in the United States of America from the rates perspective.
Right. So
then is it 4 rate cuts as opposed to the 3?
I think we might get to 4, but there's a horrible problem in the U.S. in that we have this Byzantine way of calculating inflation. So we have this terrible shelter calculation. It's purposely delayed by 6 months, and it's delayed really by 18 because they look at renewing leases versus what we know is going on. There's this thing called the internet you can use. It's like the terminal. You look things up and you get real-time data. You don't have to go by that. And also, I don't know if you noticed, but financial services inflation went up by an annualized 30% last month. So I wish that were true here being in the financial services industry, but that was just because AUM went up. And so we could all say, oh, that's irrelevant, but that's going to go into core PCE. We're 0.5. I know that some analysts are a little bit below that.
Right.
So I don't think the Fed is going to cut until we get
but
year
Jay,
down to 2.5.
this presents an issue because it's not even just the makeup of that data. There's been a lot of criticism about survey data, for example. Things like JOLTS, what have you, that the surveys just aren't good. They don't have a lot of respondents. If we're supposed to be in the land of data dependency, what do you do if the data is not dependable? Well, the Fed, unfortunately, got burned by their transitory call. So they're just going by whatever is reported as PCE. They should go in and adjust it. If you adjust, we've published data that adjusts for shelter. It would be below their target, but they're not going to do that.
So you're a natural buyer on the sort of Damocles-like days when you see bonds back up at 425, maybe even take a little bit higher. Your natural proclivity is to step in and be a value buyer of yield and also any substantial dips on these equities. Because you've got 5,500 as your target for the end of the year on the S&P 500, which is, quite a 10% higher than where we are at the moment. That's quite a reasonable call.
Yeah, well, we think that's actually too low, and we'll probably upgrade that forecast when we get visibility on the Fed. We're a little bit cautious now, and we got kind of lucky that the Eurozone data happened to come out right after our data. And, you could probably play PCE core as a negative inflection, but we don't think you should overplay it. So you should buy the dips, but just be aware that this isn't just going to go to the moon. It's nice we have AI stocks that supports the market. The UK and Europe are supporting it through the bond market. But we think we'll be range bound until we get better clarity on this data. Because it could be that, because shelter is just really kind of a fantasy number, we may not get to that 2.5 until August at least. So everybody should be aware. This happened last year. You can't get ahead of things. We thought it would be super bullish. We were correct. But it took till December for the Fed to pause. So, but you shouldn't be too clever and say, oh, well, if PC core is going to be terrible, I'll short the market, because we might power through it, particularly with all these headlines coming out in Europe that really validating our view that they are going to cut. They need to cut. They basically killed the patient. The easiest way to cure inflation is to kill the patient.
Okay.
We don't have that advantage in the U.S.